You're still watching News Now on News Central Television. We now pause the news to bring you the second part of the CSCS AMEDA conference holding in Lagos.
In areas like technology, there's already, we see in the startup world through, my involvement with something like Endeavor, we see some very, very strong cross investments, actually across the region. It will be in financials, sooner rather than later. And all of these elements really create very, very substantial opportunities for cross investments. I think from our perspective, Africa needs to play to its comparative advantages. And those advantages, first and foremost, are that we're the, probably now the most valuable carbon sink in the world. And if you're thinking about these markets and you're not thinking about carbon, big missed opportunity. We're an incredible source of resources, oil which the Gulf doesn't need, much more of, and gas, but more relevantly, really valuable minerals for battery technology, really valuable minerals for electronic vehicles, and really valuable minerals for other sorts of industrial processing as well as digital infrastructure. Where this tremendous market with this incredible solar potential and hydrogen potential, which, again is, of value to the Middle East. So it's really about, how are those who run our market infrastructure, our intermediaries, thinking about the dislocation that's happening in the rest of the world, the fact that countries are shifting money away, from aid to defense budgets, showing less of an interest in what's happening in our markets. How does that translate into a unique moment for us, actually, to try to seize the initiative while all of this noise is going on?
And as a smart investor, you don't want to miss those kind of opportunities when they come. All right, so Dr. Olayode, so I'd just like to get what you're seeing, the horizon, going forward for these two regions, looking to collaborate and, make the capital markets more deep.
Speaking to Africa once again, as you're aware, with the AFCFTA, there's been a lot of progress towards the protocols, but the digital trade protocol, for instance, amongst many others. And a lot of this, quite frankly, align with what is also happening in the Middle East, even in terms of, say, the Pan-African payment systems, you have Bona in the Middle East. And most of this, quite frankly, are trying to ease transaction flows. But permit me to say that, and to go back to what I was saying, we're having a lot of alignment as we speak. Now, I think we need to move a little bit further to ensure that the interoperability of those systems, right, work well. So if you take the capital markets in Africa, for instance, there's a lot of conversation, for instance, on can you, for instance, buy stocks in the Nigerian Stock Exchange on the NGX from another country. We're having progress with that. But can you do that from, say, MENA at this point in time? No, right? But MENA has made a lot of progress. What are the learning points we can take? How fast can we integrate? How fast can we accelerate some of this progress? I see that as we move closer to 2030, right, we will have a lot more interoperability. That, quite frankly, is a key if you like, requisite for progress. The good thing is that these conversations are happening, and it's also very good that AMEDA is also definitely one of the catalysts for this growth. As I wrap up, let me quickly extend, if you like, deep commendation, right, to the key operators in the Nigerian capital markets. The Securities and Exchange Commission, the NGX, the CSCS, for the incredible work, right, done to ensure that the Investment Securities Act, the most recent one, has been passed. because that contains a lot of innovations that arise in the Nigerian capital market with what is happening in the best of the vendor markets, right? And trust me, we should, as we move to implementation, see a lot more progress.
Thank you so much for that, Mr. Olayede, and thank you all for being such a fantastic sport and keeping the responses as short as possible. But I don't know if we have any questions from the audience. We can take one question, quickly. If you put your hands up if you have a question for us. Okay, so no questions at this point. So I guess we have educated the audience very well. Thank you so much. Again, it was great having this conversation with all of you.
Thank you.
All righty then. Things over to Eko.
Nicely handled. Please put your hands together for Mr. Ladi Williams, and also join me and appreciate our panel. Thanks to Ms. Hanan Al-Shari, who joined us virtually. It's actually one of the toughest things to do, to join a conference virtually, because you're watching and you're not quite there with everyone, but you have to stay attentive. And funny enough, everybody is watching you. It's the toughest thing to do. So we thank all our guests who've joined us virtually, and then also please put your hands together one more time for our chairman, AMEDA, Mr. Jafar Abdin, who has been up on stage quite a few times today. Also, please put your hands together for Mr. Bolaji Balogun, who did a fantastic job as well. Don't get tired with the clapping. You can do a lot better than that. Thank you. Thank you. Also, put your hands together for Dr. Folari Alayande. Thank you. Thank you. Okay, it's time for our next speaker. This speaker is coming to us virtually, right? And I'm going to ask, because she's coming to us virtually, that you give her a little bit more attention than you've given to our physical speakers. It takes a little bit more, from you to learn from someone who's not present. You've got to lean in. So I'm going to ask if you would kindly hold all conversations, stop all conversations until later, and give your full undivided attention to my next speaker. And I must say about my next speaker, she is deserving of your attention. Quite a great mind that we will benefit from. But apart from her mind, it's her experience. She sits at the top.
Recording in progress.
She sits at the top of a global entity that is an association for exchanges around the world, exchanges and CCPs. And not just, when I say exchanges, not 1, 2, or 3, I'm talking about 250 exchanges around the world, right? And amongst them, there's something like 45,000 companies listed, with market capitalization of about $82.5 trillion. Now, I'm saying all of this because her wealth of experience as the CEO of the World Federation of Exchanges cannot be discounted. She interacts with exchanges that operate in different regions with different scenarios that they face in their country. So, ladies and gentlemen, please give your full, undivided attention to Ms. Nandani Sukumar. I think she's joined us now already. She'll be speaking to you shortly. There she is. Please put your hands together for her one more time. Ms. Sukumar.
Good afternoon. I'm so sad that I'm not there in the room with all of you in Lagos, with our members and with all of you at AMEDA. Thank you so much for the invitation to join you this afternoon. It's always a special experience and a moment to join our colleagues in the CSD world, and we look forward to working more with you in the days ahead. When you invited us at the WFE to speak, you gave us a clear brief, and I smile when I say clear brief. The title is Innovation in FMIs, a game changer for growth. So it was a wide range of topics you gave us there, that all also incredibly pertinent to the joint challenges that CSDs, exchanges, and CCPs together are facing. At the WFE, I always say that together, because we represent exchanges and CCPs, and AMEDA represents the CSDs, that together we represent the entire value chain of the market. And that has never been more important, this collective vision, this approach where we work shoulder to shoulder, than it is today at this time. The WFE is, as we say on the lid, the Association for Exchanges and for CCPs. So we represent around 250 to 300 market infrastructures around the world. We represent everyone but CSDs, and that's why we're here together today. We have numerous joint members with AMEDA. So again, a classic example of CSD, CCP, and exchange working together to serve the markets that you operate and that CSDs are so important in navigating risk for. We have at this time about 87 members who are CCPs and clearing services. So we are the world's largest association for CCPs. And the rest of our members are exchanges. We tend to be exchange groups, with many of them with the CSD sitting within that group. We have data that goes back, many of you are familiar with and have contributed to, that goes back almost 50 years, and we look at over 350 market data indicators, all of which the CSDs are servicing through their functions. So why are we here today? We're here to talk really about our industry, the FMIs, as catalysts for growth and for economic transformation. When you came to us and said, let's talk about this, we thought, really, this is a shared moment. Never more, I think, never in my time in the industry has it been so important to talk and understand how it is that we as FMIs, and I'm using we in the collective sense, are indeed catalysts for economic transformation. In January this year at the WFE, we published a research paper. It's free, it's available on our website. It was authored by my colleague, Dr. Ishaq Damir, and the title was really very simple. We talked about financing the future. And with that, we looked at a number of indicators to look at how FMIs are influencing the economy and resilience and prosperity, in addition to creating value for stakeholders and removing risk from markets. Those are all things that all of you in this room, the AMEDA members, work directly with. In particular, we found that financial market structures, and again, I'm using we in a collective sense, give people a path to financial security. And let's hold that thought as we think about the role of the CSD industry there, in addition to that of the exchange and the CCP. We all collectively help companies, new and old, large or small, to prosper. So if we think about the impact that the CSD industry has on companies and their path to prosperity, there's always a belief that it's the exchange. But it is not just the exchange, it is all of us together in the ecosystem of which the CSD is a valued part. We provide a clear signal on the health of a country. Think about the risk that all of you are managing, especially in African markets. We support growth and contribute indirectly to tax revenues, taxes we will always have with us. We channel funds in the necessary scale to strategic sectors. We form the foundation for other financial markets. That's particularly interesting as we see the emerging trends there of new public markets. We attract international money, again, a particularly interesting concept to hold and think about in emerging and frontier economies. And of course, we ensure system-wide soundness and resilience, underpinning insurance and promoting, of course, public engagement and trust in regulated structures that underpin the global capital markets. So as policymakers and industry leaders, look to build and grow, economies, it is essential that the role of market infrastructure is recognized and supported. These institutions, our institutions, are not just market operators. They are indeed engines of opportunity, and the policy and regulatory environment should be designed to nurture these markets as a foundation to sustainable economic success. So now, the second brief that we were given was we were asked in our comments to reflect a little bit on DLT, tokenization, and CBDCs. And really, looking at the specifics around innovation and FMIs, this is just what we think. We can act as game changers, not just for capital markets, but for growth, inclusion, and resilience across, all economies. Let us begin, with DLT. It continues to generate enthusiasm for its potential to increase transparency and reduce settlement friction. And I think all of you in the room there in Lagos will be able to tell us quite a lot about your individual experiences. If you look across the capital market ecosystem, you have SDX, SIX Digital Exchange, where they are a fully integrated infrastructure based on DLT blockchain technology, and they're enabling issuance, trading, settlement, and custody of digital assets. Others, like ADX in Abu Dhabi, are using blockchain to modernize AGM voting and improve shareholder governance, for example. However, innovation must be informed by evidence, not assumptions. For example, tokenization is often related to the concept of DLT, that is, for example, converting ownership rights or assets which have traditionally existed as physical or centralized electronic records. And these then are morphed into digital tokens on a distributed ledger. However, when we looked at the issues surrounding all of this, we wrote a paper, actually, again, on our website, Demystifying Tokenization, led by my colleague, James Olaf. Many of the claimed benefits of tokenization already exist, often provided in a very efficient way by the CSD. And they can be achieved and are already being addressed through so-called traditional systems, of which the CSD is the foremost. Tokenization also introduces fresh challenges: legal uncertainty, technical complexity, and custody risks, of which we have all heard a lot, especially in fragmented or unregulated environments. Looking further, we had we've published a paper which we presented at our WFE Clear meeting, which is a post-trade and CCP meeting. We looked, my economist colleague, Dr. Kaito Lin, presented a paper on settlement latency in DLT systems, and we found that it materially reduces liquidity and raises trading costs. And we took a lot of data, we ran a lot of very rigorous analysis, quantitative analysis, and simply put, so-called instantaneous settlement is very rarely instantaneous, as I'm sure all the CSDs in the room can attest to. It's subject to the uncertainty implicit in the blockchain validation process. And when uncertainty is present, in general, market efficiency suffers, as we all know. Spreads widen, participants may hesitate to trade. This is a moment where we all think about that as we look around the world at the volatile markets that we have all been living through for the last 2 weeks. And indeed, these effects are particularly significant in systems without netting, where trades must be pre-funded in full. This reinforces the value of both CCPs and CSDs, which remain indispensable in managing risk, enabling multilateral netting, and reducing uncertainty. Recent research from URX and from DTCC outline the use cases for using tokenized versions of traditional assets to enhance collateral mobility and margin management without sacrificing that legal and operational safeguard of central clearing. And this is why regulatory initiatives matter. Although projects like the ESMA DLT pilot regime have only had limited success so far, they promote responsible innovation. Let's hold on to that word, responsible. They allow exchanges and CSDs to experiment within a defined regulated framework. It is a reminder that real progress happens when innovation and regulation advance together, and that tokenization will only scale if built on foundations of trust, interoperability, and regulatory clarity to leverage the strengths of market infrastructures. Finally, we are also seeing growing interest in central bank digital currencies. They are still at an exploratory stage in many jurisdictions, but present important considerations, particularly for wholesale market use in post-trade processes like settlement and related margining. The attraction is the same as with stablecoins. That is, they're cheaper and easier to use than fiat, but with the added credibility of being backed by central banks. This starts to look very interesting when you consider their use as a store of value and not just as an exchange of value mechanism. We will move on to the hottest topic of the moment, if you like, which is AI. And then less hot, but very important to all of us who work in market infrastructure, the cloud. The debate around cloud computing has become ubiquitous. So I think, all of us go to these meetings and we talk a lot, about the cloud and what it means. Many of our members are now operating models where on-prem computing on their own servers is paired with cloud computing. So the direction of travel is, unequivocally towards the cloud. While some are moving fully towards cloud computing models themselves. CME Group is partnering with Google Cloud, the Options Clearing Corp. OCC has partnered with Amazon Web Services, and both, are moving, talking about core platform, core clearing systems to the cloud to enhance stability and risk management. The exchanges at the front end are also, but they are marching towards the cloud. AI may also play a transformative role via a number of use cases. So at this point in the AI conversation, all of us in market infrastructure are looking at the FMIs. We're all looking at use case now, right? How can we turbocharge? How can we enable our markets using AI? If you look in Asia, SGX is applying AI to market surveillance, identifying anomalies at scale, while in the Americas, B3 in Brazil is leveraging AI-generated avatars to expand investor education, proving that innovation can also deepen financial literacy. Takash Bank and Borsa Istanbul recently outlined that they are applying AI across their CCP operations to enhance collateral calculations, credit rating processes, and stress testing. There's a very interesting article, again free, on the web. If you look at, you will find that they detail in some length how they're doing this. Hong Kong, HKX in Hong Kong has adopted agent-based modeling to simulate default management and liquidation strategies within its CCP. And by realistically modeling trader behavior and market reactions, HKX is improving how it manages risk under stress. All this taken into consideration, the WFE, we strongly support a principle-based, risk-proportionate regulatory approach to AI, one that is flexible, forward-looking, and based on outcomes, not overreach. Our members already follow sound governance practices, as do the CSD industry, and we include a human-in-the-loop oversight we have clear model documentation, and we follow rigorous vendor risk management practices. All of this is business as usual to CSDs, CCPs, and exchanges. As reliance on third-party AI systems grow, transparency and accountability across the ecosystem will become even more important. Now, let's talk about the role of regulation and sound marketplaces. As innovation advances, so must our regulatory thinking. For example, recently, if you look, we wrote a regulatory paper, Sound Marketplaces for Crypto and DeFi. And here we looked very specifically at crypto trading platforms, and we looked at the need. Crypto as an asset is a new asset class, and in time already it is being traded on exchange, but that move as an asset class will move further onto the exchange, and that is a great thing for it to trade, and for the CSP to settle. So where do we find critical need? We find critical need, we need clear segregation of functions in vertically integrated platforms. We need AML compliance and cyber resilience. We need transparent governance and investor protections. And finally, we need regulatory parity for all similar activities, regardless of the technologies used. Let's look for, as an example, on the collapse of FTX. It resonated across the world. Long-standing worries about, insufficient custody controls in the crypto industry. This highlights the risk to both markets, to market integrity, and investor protection. But regulators and crypto providers can learn and should learn from so-called traditional markets. We are not so traditional. We are evolving, all of us, to keep pace with our stakeholders and the needs of the markets that we run. But the traditional markets that we are allegedly running have a track record of functioning well, especially in times of stress. In established markets, custody services offer a comprehensive range of functions, including compliance, risk management, and asset servicing. And these could significantly enhance the robustness and credibility of crypto asset custody. In particular, these frameworks recognize the importance of segregating crypto assets in the event of a bankruptcy, meaning that clients can expect the same protections that exist for investors in existing financial products. And that is really like a very profound benefit. We hope to see frameworks like these established in all jurisdictions, because new technology just cannot justify weaker oversight. The principle of same activity, same risk regulation, same regulation must apply across all market environments, centralized or decentralized. So, in conclusion, innovation with purpose. In closing, I would like to return, if you will allow me, to the core of today's conversation, the conversations that we heard before us, the conversations that will come after the session and on into tomorrow. How financial market, these are focused on how financial market infrastructures are not just background systems, but really they are the connective tissue between investment and innovation, between savings and sustainability, between trust and transformation. As we navigate new technologies and new expectations, our challenge is not simply to adopt innovation, but to apply it wisely, and with rigor, with responsibility, and with purpose. That means building systems that are inclusive, building markets that are resilient, and building regulatory frameworks that evolve in tandem with technological change, even while leveraging the existing strengths of established infrastructures. Let me end with a call to arms, a call for solidarity, a call to walk this road with us. Together, all of us, the exchanges, the CCPs, the CSDs, we will move forward. Let us move forward together. We are grounded in evidence. We will move forward grounded in evidence, guided by principles, and united in our ambition to build stronger, safer, and more sustainable economies for the generations to come. Thank you once again for inviting us to join you. We wish we were in the room with you, and we look forward to working further with you to enable the shared vision of a better future that we all have. Thank you.
Thank you very much, Ms. Nandini Sukumar. Very, very appreciative of your time, but more especially of your insight into how we can come together and build financial markets infrastructure that will last and that will be not just sustainable, but that will grow, across Africa and the Middle East. It's time to dive into our next panel session. As you can see, they're prepping behind me for you. And we're almost getting to the end of the evening's conversations. We'll continue again tomorrow. We're not there yet, but they say the end of a matter should be the best part of it. So I want you to keep your attention wrapped. You guys have been a stellar audience so far. Thank you so much for giving your attention to Ms. Sukumar. Please put your hands together for yourselves. I appreciate you. Thank you. All right, it's time to dive into the next conversation. This one is going to be about driving the financial inclusion through digital technology as well. There's been a lot said about inclusion today, and moderating this panel is going to be a gentleman who comes from the Lagos Business School. He's the dean of the, my bad, I said gentleman, a lady from the Lagos Business School, the dean of the Lagos Business School, and she's going to be sharing some of her insight with us as she interrogates the matter with her panel. Ladies and gentlemen, please make welcome Professor Olayinka David West. As she comes, I'm going to jump right in to call on the rest of our panel. From MTN, representing their CEO, Carl Toriola, please make welcome the Chief Strategy and Innovation Officer, Mr. Babs Oyeleye. There he is, all right. And then from NIBS, ladies and gentlemen, representing their CEO, Mr. Premier Oiwo, please make welcome the Head of Technology and IT, Mr. Oluseyi Ademosu. Thank you, sir. Joining us also from Aluko and Oyebode, please put your hands together for partner, Dr. Ajibola Asholo. She wants you over there, sir. Thank you. She's specific. All right, next up, please make welcome Chairman NESG and Managing Partner, Veraki Partners, Mr. Nee Yusuf. Thank you very much. Professor, your panel. He's making his way. Please put your hands together for Mr. Nee Yusuf, who's joining us as well. Thank you.
Good afternoon, everyone. Good afternoon, everyone. Thank you, thank you. I know we're keeping you between the end of your day and your last meetings, but thank you all very much for staying to have this exciting conversation with all of us. So I think we've talked about financial inclusion, and we know what financial inclusion is, I hope, right? In terms of access to and the use of financial services that are affordable. And how do we go down market? Today I have the honor of having this conversation with my panelists, and basically my job is really just to interrogate them and get their ideas and their views around how do we use a lot of the emerging technologies that we've spoken around, how do we ensure that we avoid the CBEX issues rather as we're taking it in. And I think Falani was talking about digital trust and ensuring that we build digital trust. So that is the nature of the conversation, and we're hopefully doing this in is it 40 or 30 minutes? Because I see my clock is ticking already. But we will try and have a conversation as we can. So let me start with you, Babs, at MTN. And because we're talking around the Middle East and Africa region, what is MTN's footprint, and how do you share MTN's experiences in financial inclusion in that region? Thank you.
Thank you. Can you hear me?
No.
Nope.
Not yet.
Your mic's not working.
My mic is not working.
Not yet.
We'll replace that with a handheld in just a second.
Okay, while we're waiting to save on time, let me come to you, Sheyi. And, okay, so Sheyi, you'll wait.
Okay.
Thank you.
All right.
Okay, thank you very much. So MTN started our journey in financial services around 2006. I think we first launched in Uganda, and our footprint now covers 17 countries, predominantly in Africa, and that's mainly because we've started to scale back our Middle Eastern investments. And we have, I believe we have about 1.3 million agents spread across our Africa footprint. We have about 63 or so million monthly average users across our footprint. It's been quite a journey for us. I think we set out to focus on the rural, semi-urban, really the really underserved territories across Africa. And that's because we had some capabilities that we could leverage on. Naturally, we had a mobile service. Secondly, we had very wide distribution across the territories, and we had agent footprints already established in those territories. And I think those capabilities, and then on top of that, we just layered the trust in our brand. I think that was really the key element. And those three capabilities really are the most important things that really helped us to drive the growth of our footprint across Africa.
Okay, thank you. But let me segue on to Sheyi. But before you do, what are the 63 million doing on your network?
We started out with the basic services. We started out with USSD, naturally, and then you evolve your service from your cash payments, transfers, and then your remittances, and through the agent network, you're able to do your cash in, your cash out. Now, as you start to push your smartphone penetration, you can then layer on slightly more advanced services. So in some of the other markets, there are insurance products, there are loan products, there are savings products, investment products, etc. So effectively, we do offer a broad range of financial services products right across the footprint. Some markets maybe not as much because there are some restrictions in some of the markets.
Okay, great. So we have some regulatory barriers. But so he's set you up now. Payments. And NIBS is the engine of payments in Nigeria. So tell us a little bit about how are we leading in the instant payments in the region, and how do we ensure that we can bring payments further down market to the micro level? So basically, I think my best use case is how can I buy gala digitally in traffic? Thank you.
All right, thank you very much. It's a pleasure to be here. I'd like to thank CSCS and AMEDA for setting this up. NIBS is a company owned by the deposit money banks and central bank jointly. And the role of NIBS is to act as a facilitator and a clearinghouse. For the last 30 odd years, what we've tried to do is to provide rails that our partners can take advantage of. And therein lies the innovation called NIBS Instant Payments, NIP. Now, when NIBS Instant Payments started in 2010, we had only 3 banks that were locked in. But today, I'm sure everybody here, you use your mobile app or USSD to transfer funds, and you get it instantly. What that has afforded the economy is in no mean way. You find that government is now making payments electronically. Government-to-person payments can be tracked. You have transparency, you have security. You can actually say this is the person that made this transfer. So the rails that we have provided has afforded a lot of innovative products to come up. In the last panel session, someone was talking about OPay having 40 million odd customers. Where were all these customers before, right? Were they being managed by traditional or conventional banks? So you see that a company like OPay can come into Nigeria, establish its roots, and do its business because we had a rail that connected all the parties within the ecosystem. That cannot be overemphasized.
Okay, great. Thank you. So, Sheyi has led us into the rails, but I think the rails are important, and what they've sort of provided a democratized access to different groups of people. But let's look at it regionally as well. What is your experience, and how have the banks, because the likes of the OPays are the ones that we call the emerging new actors in the ecosystem, the new business models, and seemingly threatening the legacy of the traditional players. So what is your experience in the regional area, and what strategies are being used to ensure that banks remain competitive and continue to offer the retail services, especially as it relates to trust? Because Dabalala said, MTN relied on their trust brand. Sheyi says, we built an environment and rails that people can trust. So how do we ensure that we continue to foster the trust and use the rails that have been provided?
Thank you. Interesting question. If you look at the continent, right, so it's 54 countries, and all at different stages of development, and you then take the Middle East, you added up another layer to it, probably much more developed than quite a number of countries on the continent. And if you come back to Nigeria, actually let me start at two. So if you look at Nigeria, Nigeria is many countries in one, right? So Ikoyi, Victoria, and Lekki is one country, and then Lagos is another country that covers it, and then you have the Southwest that covers that, and you have the larger Nigeria that covers it. And financial exclusion in Nigeria is driven by infrastructural gaps, right? So you have many submarine cables that have come to the Lagos, and I think now we are probably having just one in the south region. But you need to find ways to pull that into the hinterland. So infrastructural gaps, costs. In an economy where more than 66% of us are still multidimensionally poor, the ability to afford smartphones becomes an issue, and that's where the Chinese brands have become more popular, but that allows you to improve the affordability. Trust is also an issue, and I think that's where banks still have a play. To the extent that banks are regulated, to the extent that banks have developed a trusted brand over years, quite a number of consumers are still, most of them still keep accounts with commercial banks for safety reasons, and then you keep accounts with some other fintechs and co for convenience, for speed. What we've seen that financial inclusion in Nigeria has improved, driven by 3 or 4 factors. The presence of fintech, agency banking. So Babs talked about they having about 1.6 million or so agents. So that's the last mile. And so agents in Nigeria today is just an umbrella, a stool. And so cost to set it up, that is low. So agency banking, mobile money, fintechs have helped in terms of increasing the reach of financial services to the last mile. In 2018, MTN did an IPO in Ghana, and about 84.6% of the local participants subscribe through MTN mobile money. Now, which shows again how mobile money, how mobile phones have helped. And in Nigeria, we surely have more mobile phones than bank accounts today. Okay. And so, if we could have that institutional collaboration between the telcos and your digital identity capability and the banks, then we probably could be able to improve affordability, improve accessibility, and also increase the trust between the three. So we have the ingredients. We just need to have more collaboration and a regulatory framework that allow the easy exchange across the 3 areas.
Okay, great. Me, I'm going to come back on the issue about broadening, especially as we diversify services, because he's spoken about services like insurance riding on top. You've spoken about IPOs and access to capital markets using Momo. So we'll come back to it, because basically, Sheyi, what they're saying is that payments are stale, right? We need payments, but we can do other things in addition to payments. So Dr. Asolo, people have spoken different times about regulation and the different types of regulatory environments that we have in the environment. So let's, on a scale of 1 to 10, right? In terms of regulations driving or advancing or promoting financial inclusion, how would you sort of rank the regulatory environment and then justify your score?
Okay. Can you hear me? Brilliant. Thank you to CSCS and AMEDA for putting this together, and thank you very much for inviting us at the end to add a voice to this. I would give it a strong 6 out of 10 for a number of reasons. Some have been outlined already. But from a regulatory perspective, I think the first point would be that there is just a recognition now that expanding digital financial services and financial inclusion are some sort of public good. So we see that in policies and regulatory documents that are put out by regulators. This underpins it. So that would be the first point, and it's the reason why, for example, regulatory entities like the CBN has created a whole bunch of license categories to help advance this cause. So that would be the first point. The second point would be one that's been alluded to on this stage already. The framework itself, as it pertains to mobile money, has been very positive and has delivered very positive outcomes. I would contend that it's probably one of the single largest drivers of the expansion of financial access on the continent, and very specifically in Nigeria. A second point, or a third point, would be just what the regulators are doing as it pertains to regulatory sandboxes. These allow fintechs and operators to test and validate ideas and propositions in a controlled environment, and still gives the regulators the capacity to basically look out for all the typical financial market risks. So that's been helpful as well. The SEC is doing something in that respect. CBN is doing something in that respect as well. The point has already been made on how the regulatory environment has advanced and helped payments. The key point that's made on the NIBS NIP payments, that is obviously a plus. And I think a final point I'll allude to would be what the regulatory environment has done as it pertains to consumer protection and data protection. So on the data protection side, we do have a specific law in this country that looks at that. In addition to that, we also have on the consumer protection side a federal regulator that advances the cause of consumer protection. Certain states, certain subnationals are looking to do work on the consumer protection side as well, so that obviously is a plus. So yeah, altogether I'll give it a 6. Clearly there are some issues in the regulatory environment that we need to unlock. Regulatory fragmentation is one. The notion where you have different regulators superintending different components within the ecosystem creates friction, so that does need to be unlocked and solved. Regional harmonization is an issue. On the continent, different countries have different legal systems and compacts, so obviously that creates some friction as well. We have the AFCTA that's come into force now, but it will take some time to kind of operationalize that across the continent. When we get to the point where we can do passporting, as we have in the EU, obviously that advanced the cause as well. And the final point is one that I'll point out, I alluded to somewhat, which is just the telco bank dynamic. There is some friction in that space as well. Once we're able to unlock these 4 things, it will help advance this a little more. Thank you.
Okay, great. Thank you very much. So we have the regulations in different levels of development, but I think one thing I struggle with, and I think it was also spoken to at the previous panel, that when we talk about financial inclusion, yes, we've done relatively well in payments, and when we measure, we count, access to a transaction account, so we're doing well. But then again, we're not doing well in other areas, and one of the areas, and I think it was in the one of the sessions this morning talking about how do we unlock this $1 trillion economy that President Bola Ahmed Tinubu is promoting. And one of those areas is access to credit. We have a ton of MSMEs that really don't have access to productive credit, either it's working capital, whether it's asset-based financing and things. So we have digital credit providers. Bola spoke around the crowdfunding regulation and the fact that we have 6 licensed crowdfunding operators. So we have the supply side. What is inhibiting and how do we start to unlock, especially access to MSMEs and the credit so they can actually do their business and grow the economy at that level as well? Thank you.
Access to credit is an issue, but the cost of credit, it's a bigger issue.
Okay.
And
so there's credit, but it's just expensive.
Oh, absolutely.
Okay.
So if you look at the quite number of fintechs, they slam you 3%, 4%, 5% flat monthly, which then comes to like 40, 50, 60% per annum. And if you don't have a choice, you do that. So with inflation at what it is, credit can't be cheap. And so we've got to find ways to remove the structural bottlenecks to bring inflation down so that the cost of credit can then reduce. But a few things gives hope. So one is the federal government now has the credit corporation, initially focused on the civil service or the public sector. Now, it's a good start. The second is you have the student loan. It's also a good start. Hopefully, through those two schemes, you can begin to